Hi, welcome to Grand Insights. I'm your host, John Feligno, founder of Grand Life Financial. Keeping up with all the tax legislation changes makes it challenging to know what you can do to reduce your income taxes. So today, we're going to review some of the ways that you can reduce your taxable income while you're working, as well as after you've begun retirement. You may have losses in your investment portfolio from positions that are now worth less than what you initially paid for them. So by reinvesting in a similar asset class to remain diversified, the captured loss can reduce future gains and help offset capital gains tax exposure. This is called tax loss harvesting. So when you're doing this, it's very important that you do not create a wash sale, as that's prohibited. So if you properly execute this strategy, you can also carry the remaining losses over to future years. Owning a home is a great tax shelter. While you're paying a mortgage, we typically expect the value of our home to increase over time. So for a married couple that sells their home, they'll receive a tax exemption of the first $500,000 in profit. Rental investments can also provide tax benefits, but there's rules for who can take deductions for those properties. A tax-deferred retirement account can be used as a tax shelter by maximizing your contributions during your working years to a 401k, a 403b, possibly even an IRA, depending upon your total income. So these contributions reduce your taxable income and the money grows tax-deferred. However, keep in mind this is not a permanent tax shelter, as you'll be required to pay taxes when you begin taking distributions in retirement, which is also known as required minimum distributions. For those that are near retirement, a Roth conversion may be effective, especially if you have sizable qualified retirement accounts that can incur high tax rates later in life. So besides qualified retirement accounts, some additional tax sheltered investments include municipal bonds, which are very tax efficient because they don't incur federal taxes, and often the interest income is tax exempt at the state and local level. Treasury bonds are tax efficient as they're exempt from state and local income taxes. So among stock funds, exchange traded funds, ETFs, tend to be more tax efficient than mutual funds as they have fewer capital gains. And collectibles can also be a tax sheltered investment, which includes things like antiques, art, and luxury watches. A 529 plan is another great tax shelter, and it also provides savings for a child's college education. So in addition to being tax exempt from federal income taxes, some states allow you to deduct contributions from your state income taxes where that applies. Besides the additional income that a side hustle can provide, starting a business would allow you to take numerous tax deductions that's available to small business owners and self-employed workers. Paying for group insurance premiums with pre-tax salary is another way to reduce your taxable income. Employers may offer some fringe benefit plans such as flexible spending accounts or FSAs and deferred compensation. A health savings account or an HSA may be available if you have a high deductible health insurance plan, as these not only allow you to make a tax-free contribution, but the money grows tax-free and the withdrawals are tax-free as long as you use them for qualified medical expenses, so you're getting triple tax benefits. A qualified charitable distribution allows you to use your IRA to make donations to a qualified charitable organization and satisfy your RMD, thus not having to pay the taxes on your retirement savings and fulfilling your charitable intent. You have to be 70 and a half years of age to do this. By reducing your adjusted gross income, you may also have the additional benefit of reducing your Medicare surcharge or lowering Medicare income-related monthly adjustment amount, which is known more commonly as IRMA premiums. Donor Advised Fund provides a tax-deductible donation that grows tax-free until you recommend a grant to the qualified charity. You receive a tax deduction in the year that you contribute, even if you choose to distribute the money in the future. One additional donor advised fund strategy is contributing your appreciated securities that minimizes future capital gains taxes. And finally, by properly structuring your estate plan, You can create tax-favorable wealth transfer strategies that ultimately leaves more assets to your heirs or a qualified charitable organization. If you'd like to learn more about any of these tax-saving strategies, please feel free to email or call me. And if you have questions for future topics, please send those along. Thanks very much for joining.